Hi, I'm Will Hoffman, president and founder of Hoffman Wealth Management. And I know the markets have been a little wild lately and maybe causing some folks to be concerned, and justifiably so. Market volatility is never comfortable. But I just wanted to give you a little bit of information from LPL Research, which is a great partner to us, about what market volatility looks like, how frequent it does occur, and some good things to remember during this period of volatility. Remember, stocks have compounded a very attractive 10.1% annual growth rate since 1900. Though the Dow can't be invested in directly, this is an attractive potential return over time and highlights the attractive potential of long-term investing. You can see the y-axis is displayed in log scale. Stocks have historically risen much more often than they have fallen historically. Based on rolling monthly time periods since 1950, the S&P 500 has risen on price basis, which is excluding dividends, 92% of the time over 10 years and 100% of the time over 15 years. Over shorter time periods, gains are less likely, but still much more likely than not. The key takeaway here is to stay invested. Market timing can be costly. If you see here, missing the market's best days can be very punitive relative to remaining fully invested over time. Over the past 65 years, the S&P 500 index has only had 5 big down years of 15% or more. All came during or around recessions, except 2022, which certainly had some characteristics consistent with a recession, and an unprecedented spike in yields from historically extreme low levels. Pullbacks are normal. On average, the S&P 500 index will pull back 5% or more 3 times per year. Volatility is also normal. On average, stocks are up about 9% per year, and the average pullback in a year is nearly 14%. Also consider that the average max drawdown in a positive year for the S&P 500 is somewhere between 10 and 11%. Earnings have also grown nicely over the long term, at an average rate of 7.9% since World War II, based on the S&P 500 index. Earnings growth has supported stock market gains over the long term. The y-axis here is also displayed in log scale. From the lows after a correction, the S&P 500 generates solid gains with a very high probability of an advance. If you've watched this and have any questions, please feel free to reach out to us at hoffmanwealth.com, where you can find me on LinkedIn at Will Hoffman, or please feel free to call our office at 724 522 5411.